A very warm welcome to the Risk Reversal Podcast. My name is Guy Adami. I'm always joined by Dan Nathan. And for the 9th or 10th time,
probably the 10th,
we're joined by Mike Wilson. He is the CIO, that's Chief Investment Officer and Chief U.S. Equity Strategist at Morgan Stanley. Company, by the way, that's doing extraordinarily well, in large part due to some of the calls that Mike Wilson makes. Hello, Michael.
Hey, guys. How are you?
Well, I'm well. We were talking before the show about my hatred of the NFL red zone, and you said it should be outlawed.
I agree.
So you are in accord with Swizzle here. Dan's like, you guys are old.
We used
crusty.
to try to come up with catchy titles to podcasts.
Yeah.
This would have been something with the OK Boomer. The kids today, they love the red zone.
I'm not interested in what the kids. You know why? Because it's all the gambling applications. It's terrible.
Everybody's
They've ruined
all in
everything.
On that. But some folks would say that playing the market is gambling a little bit. You know what I mean? I'm just saying, Mike, I don't know. You've been around for a few cycles here. Sometimes it does feel like a bit of a gamble.
But that's straight up, man. You're putting money down. I think what Guy's saying is, you go watch a game now.
Watch a game.
And everybody's, doing prop bets, and you got like 4 channels on. I'm too old. I got ADD, man. I can't.
Well, there is a prop bet going on in the market, and it's called Nvidia. And so think about that. I mean, we're recording this today. It is 3:10. The Fed presser just got done or is about to get done here. So we saw the Fed cut 25 basis points, the second this year. But he said, that'd be Fed Chair Powell, it is not a foregone conclusion. Now, Guy and I have been potting all week, haven't we, Guy? And
we've been doing what?
Podcasting. We've been rating the things that are happening this week, right? So we have possibly a China deal. By the time you'll listen to this, maybe we'll have something. We've had the Fab 5 earnings, which tonight we have Microsoft, Meta, Google. I think we have Amazon and Apple. And then we had, what else? Oh, the Fed. So I rank these things, and I'm like, oh, this is Nvidia and the hyperscalers. That's number one. Easily the China thing, whatever, and then what the Fed has to say. How do you rank those sorts of things?
Yeah, a different order. I would say the China-U.S. relations, I think, were the most important thing we had to kind of get past this week, because we didn't really know if they were going to have discussions. We didn't know what was going to come out of this. By the way, President Trump's been all over the world. All over the East. He literally everywhere in Asia. He's stopped in 7 places. So I don't know when he sleeps, but there's a lot going on. And that to me was the most important. We had to get that at least curtailed. Number 2, I think, was the Fed. Only because there are pretty high expectations now, as you and I were chatting a minute ago, about the path of rate cuts and when they're going to end QT and what other provisions can they put into the system for bank reserves, or something we can talk about in a minute. That's a pressure point risk. And then for me, it's the earnings are important, but it's not the earnings. The earnings don't matter. They can say whatever they want. What matters is how the stocks react.
Right.
And so that's TBD. Tomorrow and Friday, we'll find out.
We talk about that all the time. So let's talk about the Fed real quick. I don't know where this came from in terms of December not being a foregone conclusion. It's also a Fed that's data dependent, but there's been no data. So I don't know how they can sort of come to the conclusion that December is not a foregone conclusion, given everything that they've been talking about since Jackson Hole. Maybe he's just sort of hedging his bets a little bit there, but to me, it's still pretty much a foregone conclusion. Just thoughts on that.
Well, look, as you said, we don't have the data yet on the labor market, but I think it's somewhat of a foregone conclusion that the Fed is pivoting. Okay, they already started cutting a month ago. Now they're ending QT. So they're in loosening mode. The question is just the path, the rate of change, and how many cuts we're going to get, and what do they do with the balance sheet. To me, the third mandate is a lot more important than what gets attention, meaning
and the third mandate being
financial conditions.
Right.
And that has started to wobble a bit. The funding markets are showing a little, nothing like 2019, but we are seeing a little bit of stress, suggesting, not for sure, suggesting that we're now kind of at the break point for the baseline of reserves that need to be in the banking system for the economy to sort of operate efficiently. And that I think is a very sharp focus for the Fed right now. That's why they did the QT thing is now done.
Now the QT, we were led to believe, I shouldn't say led to believe, but I think the market anticipated QT ending in beginning of next year. So this is a month earlier. Is that big a deal?
Well, what happened is that in the last week or two, we talked to clients all the time. We had determined that there's about a 70% probability that they would end it today. Mm-hmm. So you could argue that today's announcement was a disappointment, at least to the bond market sort of world, that they thought they would actually end it today. They're going to basically end it in December. So there's a month off. Big deal. All right. Let's see how the funding markets trade. I think that's a wild card. And then once again, it's about the path. I think the Fed should be 150, 200 basis points lower
than we currently are.
If you really want to get the real economy going at the low end, okay, like the consumer, the housing market, all these parts of the market that have been essentially in a recession for the last 2 or 3 years, all the interest rate sensitive parts of the market. The problem in doing that, of course, is that you create even more excitement in financial markets, and that creates instability on an upside way, right? So
how does that affect the employment, the labor market here? Because, this is one of the things, and when you listen to Fed Chair Powell, I mean, he's, basically last year they did this insurance cut. Some folks were calling what he was done, in the last meeting and this one also that, because they're obviously very focused on the weakening labor market. But he's also very clear to point out that inflation has basically stopped going down, right? So you mentioned that third mandate, which is, financial conditions, but I don't know how another 100 basis points of cuts really helps a labor market that's already teetering, because let's go and look at some of the headlines this week. I mean, the job cuts are coming in white collar jobs now, right? You saw Amazon, you saw Target, you saw Paramount. There's going to be a lot more. We're going to see a lot of questions, I think, over the next few weeks on these conference calls by major companies, and they're going to be talking about a handful of different reasons why that's happening. I don't think it's probably AI productivity yet. I don't know. Like, how are you thinking about that? Because it's hard to see with, an economy that does seem kind of stuck here for a whole host of reasons that I'm not sure cuts really help the labor market right here.
Well, we'll see. I mean, basically, the engine of growth for jobs is small businesses, and small businesses have been essentially dormant for 2 or 3 years. The rates do help that, and the deregulation, I think, really help getting small businesses to kind of start up. That's going to be an offset to what I think is a very real risk for the labor market, which is AI, particularly in the white collar labor market. The offset, of course, also is immigration. So immigration has essentially allowed these folks to compete with middle class, lower income workers in the U.S. for these low end service jobs. So you may actually see a improving labor market there. And that's part of my thesis, which is that part of the rebalancing that I think the administration is trying to do in the K economy, restrict immigration, okay, let AI play through. And what we may see is better wage growth and hiring at the low end of the labor market with downward pressure at the high end of the labor market. That could help rebalance the economy. It's going to take a year or more to see the effects of that. But I have a different view about the economy, and I've had this view for a while. We've written about it. I think we had the recession, and I think the recession bottomed in April. And all the data that we look at basically prove that now. All the revisions to the labor market, the DOGE, the layoffs that we saw show that there was a massive spike in job cuts in March. And then the rate of change now in the labor market bottomed in April when you look at the actual revisions of the data. That's the problem with the data. It's not that the BLS is trying to screw Trump and help Biden out. It was that the data in the labor is always late, and it always gets revised. And so I think the Fed is just behind, as they always are. They're going to figure it out once the data is released, and they're going to look at all the revisions and they're going to say, oh, gosh, I guess we do need to be cutting rates more because the labor market has been worse than we thought.
So does that suggest then the unemployment rate is going to continue on the current trajectory, 4.3 to where? Where do you think it's headed?
Well, it shouldn't be a massive labor cycle, but I could see unemployment between 5 and 6% at some point.
Between 5 and 6% is maybe historically the norm, but again, we haven't seen that in quite some time.
That's right.
How does the market react to that? Because the Fed cuts have been built in, I think, in terms of where the S&P is trading.
Yeah. I think this is a big question mark. I don't think we go back to the April lows in any scenario, quite frankly, unless there's some catastrophic event. So in other words, if the market starts to think, oh my God, we're going into recession, and maybe some market participants haven't already seen this, but the stock market already priced it all in April. They priced all of this in April. And so now it'll just be some sort of a reset, 10, 15% type correction in this new bull market that really began in April. And then the Fed will get with the program, and then you can actually have a pretty good 2026.
What do you make of the current valuations? And a lot has been written about where things are trading. Yeah. I mean, we've talked about it ad nauseum. We're also quick to point out that they've been flashing red for a while. To try to trade on the back of them has been foolish, as we're sitting with S&P 500 at an all-time high. But S&P forward earnings, I think it's trading at almost 23.5 times next year's numbers. We talk about the Buffett indicator, cyclically adjusted price to earnings, a Schiller, all those things. I mean, we haven't, in some cases, have never seen these numbers. So just thoughts on if valuation still, or just some new paradigm that we're in.
Yeah. You probably won't like this answer, but I think it's the right answer, which is that.
No, I like your answer.
No, but I'm saying that because it's very off the radar of what most people are talking about. And I would say, And we've done a lot of work on this. So I think stocks have done really, really well for two reasons. A, growth in certain parts of the market have been quite good. We know those stocks, and they've carried the indices higher. The average stock has not done particularly well. So that kind of speaks to this rolling recession, which now I think is over. So the market is looking forward to next year and saying, hey, the Fed's going to be cutting. Earnings are actually going to be probably better than people think if we're in a new economic recovery. And so it's pricing in better earnings growth than what the market is modeling today, which is 13, 14%. I think it could be something closer to 20, which is one reason why multiples maybe aren't as expensive as people think. That's one reason. The second reason, which is the one that people heads explode on, is that stocks are basically an inflation hedge, okay? Particularly high quality stocks, S&P 500 being best case in point, NASDAQ even more so. Gold, as you know, has gone through the roof. Okay, Bitcoin has also done extremely well. Why is that happening? Because investors are more worried about inflation today than they have been in most of our careers, going back to the 70s. That's, I wasn't around in the 70s investing. All right, so the market is worried about inflation. Stocks are basically a hedge against that. So if you have an equity risk premium today of 0, you say, that's crazy. Why should I have a 0 risk premium relative to bonds, which is risk-free? Here's why. If bonds are giving you a good base rate of 1.5%, that's your real rate. That's 4 minus 2.5 break evens, okay? That's a pretty good base rate. Then I should be willing to take a 0% equity risk premium. Why? Because I'm worried about inflation.
Right.
So stocks give me that hedge against inflation where bonds do not, particularly if you're only getting 1.5% real. And I think inflation will probably be higher than 2.5% over the next 10 years.
Okay. I love that, by the way. So I'll push back just to push back.
Sure.
The inflation problem obviously hurts the consumer. The consumer is 70% of the economy. If the consumer becomes strapped, then almost by definition, earnings have to start to sort of ratchet back the other way. Depends
on the sector. But I would say that goes back to what I was mentioning earlier, which is that we are rebalancing the economy now. Okay, we're trying to rebalance the economy on 3 planes. One, international, U.S., that's export imports. They're doing that with tariffs and a weak dollar policy, which they say, but that's what's going on.
Yeah.
Okay. Number 2, we have consumption. We've overconsumed and we've underinvested. So how do you rebalance that? You take the tariff revenues, you give it to companies. As long as they spend it on CapEx, they get a break. Okay. So you're reducing consumption through the tariffs, and you're incenting real investment. And the third one is the K economy rebalancing, which gets back to the immigration. You shut the borders and you lower the competition in terms of labor and shelter and other resources in these communities. And the middle class, all of a sudden, the lower income starts to do better. And that will help. In other words, you're going to get a different mix of consumer. I would say next year the surprise could be that the lower end, the stocks that are levered to the lower end consumer
starts to
do better. And the higher end stocks actually maybe don't do as well because you're getting wage compression for jobs like us.
On the higher end.
Yeah.
That's not a lot of people are talking about that. So these dollar stores that have been significantly under pressure, maybe they start to reassert themselves. Some of the department stores that have been dogs now for 5 or 6 years. Let me ask you this question. We talked about the Fed. Where does passive investing play? A lot of people, I read on Zero Hedge, I think earlier this week, about passive investing and the distortions that are created by it. Torsten Slok wrote about it. That's not going away. So that just puts one more sort of arrow in your quiver, I would imagine.
Well, it depends. I mean, obviously S&P 500 is the index, maybe Qs, and these big, large, liquid, high-quality indices. But who's to say that money couldn't shift to a new index? I mean, the flavor of the day does get attention if it starts working. Okay, now we haven't seen that rotation. In fact, today I was just looking at it before I came in. The equal-weighted S&P relative to the market cap-weighted S&P is making new all-time lows right now. So like the thesis I just laid out has not really played out yet in the marketplace. So that's why I think there's still an opportunity, assuming these policies do play through into next year and we don't have some other kind of accident.
All right, let's go back to that 20% EPS growth for 2026, because I think we just glossed over that, right? So for the last 2 years, folks like us have been kind of trying to poke holes. And I think coming into 2024, there was an expectation of 13, 14% EPS growth. We didn't quite hit that. 2025, same thing. It looks like we're going to hit that, right? So a reacceleration or an acceleration to that high teens, maybe 20%. What are you kind of factoring in as the biggest drivers? Is it tax cuts, which was, I think, the last time we got 20% EPS growth back in 2018? That was a huge sort of tailwind. But it also comes back to something I read this morning. I think it was on FactSet, that if you're looking at operating margins for the S&P 500, right? So the top 10, 15 are driving this like 29%, on average, right? But if you look at everything else, it's like low teens or something like that, right? So But you also have this situation where these are not asset-light companies anymore. So and we'll talk about that maybe as we get to like the Mag 7, but talk about that 20% expected or possible EPS growth.
Yeah, it's not expected. I think the market may be expecting some of that. That's why multiples are perhaps a little bit higher than what seems reasonable. Okay, and I don't disagree that the stocks are rich. Okay, but I'm saying they deserve to be rich if you think they're a good inflation hedge, particularly relative to gold. I would argue that stocks might be a cheaper inflation hedge now relative to gold, compared to history. Okay, so we can come back to that in a minute.
I think that's fair.
Yeah. So anyways, on the 20%, it's really, so if you buy into our argument that this is a new economic cycle, that there's been many areas of the S&P or Russell 3000 that have been under earning for the last 3 years, and I can prove that. We show it in our research. So the last 3 years, the median stock in the Russell 3000, so that's large and small, has had negative earnings growth, for 3 years straight. And it's just starting to turn up now. In the second quarter, we're 6% growth year over year. That's the best growth we've seen in 3 years. So it's just starting to inflect. So what's going on? We're seeing better revenue growth, and we're seeing operating leverage because these companies have gotten so efficient now. They've been basically hiring nobody for 3 years. I mean, all the jobs creation in the last 3 years has been government, basically, and healthcare and things that are subsidized by the government. Okay, so these companies are really, really lean, and they're going to stay lean because maybe they're using things like AI or other efficiencies. And if we get a new economic cycle and we get inflation, which by the way is good for earnings, this is another different view that I have than others. I think if we don't get inflation next year, there's no chance of getting 20% earnings growth. I think we are going to have inflation next year.
In the right places.
And it's going to be good inflation.
Right.
Wage inflation at the low end, okay? Pricing power through that channel now as they pass through the tariff costs, and that is earnings power. The best year for earnings growth in the last 40 years, by the way, outside of coming out of a recession, was 2021, okay, because of the inflation. It was crazy good for small caps, crazy good for mid caps. I mean, that's when companies really
but consumers, corporates, they had a lot of money sloshing around, right?
Well, they're going to have more money in there through the waste channel. That's the whole point. And they're still the wealthy are going to be fine because they made so much money in asset prices. So there's still tons of money flying around out there. That's why the stock market goes up every week. There's tons of money. The question is, do they put it in the market or do they buy stuff? Do they invest?
You mentioned gold and, equities potentially being a better inflation hedge or play than gold, which I'll give you that. But I will push back and say I don't think the rise in gold has been on inflation concerns at all. I think it's something else going on. I mean, the central banks have been buying gold for a reason for the last 4.5 years.
Yeah.
So what is the gold story to you? What is it telling you? What do you make of it? It's been historic.
Yeah, by the way, I'm bullish gold. I still am bullish
Yeah.
gold. I think we can have a correction in here, fine. But my point is, gold offers a lot of other protections. It's not just inflation. I'm saying purely as an inflation hedge. That part of the gold bull story, okay, stocks may be a better way to get exposure there. No, gold I think is a protection against fiat currency debasement, okay, which all the developed countries are doing, and some of the undeveloped countries are doing.
And we're the most developed country in the world, and you said it earlier that the policy, whether they acknowledge it or not, is for a lower U.S. dollar. Now, it's funny because earlier this week, President Trump talked about how the dollar is going to strengthen. We want a stronger dollar. That's not entirely true. If you listen to Besant, he talks about the need for a weaker dollar. At what point is that problematic, if at all?
Well, it's not now. The dollar,
no, it's not now.
Yeah, the dollar is still relatively, is overvalued on a PPP basis, right? So if you look at the dollar relative to where rates are, real, rate differentials and other differentials in the currency market, you can say the dollar is still 10% overvalued to say that maybe more so to the yen, for example, or even the euro and the sterling. So there's still scope for another 10%. Our house view is for the dollar to weaken over the next year by another 10%.
Fair. So, but this whole de-dollarization thing, does it hit an inflection point where weak is actually bad for risk? But we're not close to that.
No, like I said, we have a 10% lower dollar based on just the fundamentals, which doesn't say anything about people losing confidence in the system. Right?
I'm not at that point.
But that's what I'm saying. But you're asking that question that to some degree, like that's when gold goes like 15,000 and Bitcoin goes to 500,000. That's not where we are.
Is that your price target for Bitcoin?
Yeah, exactly. So,
you heard it here first.
Yeah, you heard it here. But that's not happening. In fact, gold is actually going down right now. So the dollar is strengthening. The question is, why is the dollar strengthening now? That's I think a more interesting. Why is the dollar not weakened in the last 2 or 3 months? Even though the policies, the Fed's starting to cut again. The Fed is ending QT. You would think the dollar would weaken in that environment, not just against other currencies, but against gold. And the opposite's happening.
The trader will say it's just a bounce off an oversold. I don't know the answer, but that's sort of the trader hat in me will say it's a bounce, but it's going to be on the trajectory that you just talked about, another 10%, which probably puts the euro at, I don't know, 120-ish or something, maybe 121. The dollar has been strengthening against the yen, so I think that will continue.
I'll give you a different reason, and I think this is something that's worth considering, which is, so I've looked at the S&P relative to the price of gold for 20 years, okay? And without a picture in front of me, and the audience can pull it up on their terminal, but basically the S&P relative to gold made an all-time high in 1999. Okay, to me that was peak U.S. exceptionalism. That's when we had a balanced budget. The income wealth disparity wasn't there. We didn't we weren't fighting each other left and right, and there was a real harmonious view in the economy. The internet was just starting. All this good stuff. Okay, fine. So now it's down 70% since that peak. Think about that. It's down 70%. Now recently, like 10 days ago, the S&P relative to gold was almost as low as it was on Liberation Day, and it was almost as low as it was in COVID at the lows. Okay, so in other words, we reached a pretty extreme level on the downside more recently, and now S&P relative to gold is actually rocketed higher in a way. It looks like it's making a major kind of trading low. So my view on this, and I wrote about this after the last election, is I think the market is getting comfortable now that these policies I kind of laid out a minute ago, they're getting more comfortable. These policies actually are kind of
starting to work.
Well, not just only start, but they have a chance of working, and it's the right policy, the rebalancing of the three things that I talked about. And if that works, then stocks will outperform gold, because then you're going to have an actual fundamental reason to believe that we can grow our way out of the debt problem. I think it's highly speculative to make that bet still, to say long term, but in the short term, it looks like the market is coming around to that view. And I think it's an interesting observation.
What's the fly in that ointment then? What sort of puts the monkey wrench in? It's working now, but there's obviously always things you're looking at. This could derail it. What is this?
Well, I would say that the biggest risk to us growing our way out of the debt problem is deflation, is that we don't have enough growth. So we've written about this extensively, this run it hot thesis. I think we were the first ones to talk about this back in 2021, these hotter but shorter cycles. It's like the 1940s and 50s. They got to run the economy hotter than normal to grow out of the debt problem. And I think what the market is seeing is that we have a chance of achieving that, meaning 1% real GDP growth goes to 3% because you're getting better investment, better productivity, and the Fed is going to tolerate higher inflation.
Fair.
4%. I don't know, pick a number. 4 plus 3 is 7 nominal. Not 7% nominal GDP growth solves a lot of problems that we're dealing with. The debt problem being one of the biggest. And
so the spending side of that equation obviously has to remain on the debt side,
on the government side.
On the government side, right.
So, but that's what they're doing, right? They're trying to shrink the government.
Yeah,
now,
they are.
They've had some success in that. There's a lot more to do in that regard. Okay, we can talk about entitlements. I mean, whether they go there or not, but they have to find a way to restructure that liability to some degree. That's probably something for after the midterms. But then on the other side of the equation, they've got the growth from corporate spending. Okay, so instead of the government spending all the money, they want the corporates to spend the money. And by the way, the corporates have plenty of money, particularly these monopolies. Yeah. So they're incenting them to release that capital into the economy. I mean, I think it's actually a really good strategy. Look, it's risky, but we have to try something.
Try something.
Yeah, but so the Mag 7 or whatever you want to call them now, 15 of them, they didn't really need any incentive, right, to go out and spend this money.
It helps, though.
Yeah, but it's been a huge part of GDP growth, right?
That's right.
So there is risk to that. And you and I knew each other 30 years ago, 25 years ago, and we were talking about a lot of the same names. It's funny, I just hit a friend of mine who used to run a portfolio together. I was like, man, this is your market. We haven't talked about Seagate, Western Digital, SanDisk, Celestica, Teradyne. I mean, the list goes on and on. And I think what's interesting about the Mag 7, I think it's about $22 trillion. Okay,
yep.
So we have Nvidia at $5 trillion. So we had Nvidia and the hyperscalers really accrued most of the market cap gains since the launch of ChatGPT in late 2022, right? And so now they're coming for a lot of other stuff, right? So you could be the tiniest component supplier. You could be electronic, manufacturing partner of this and designing this rack for this server or whatever. Everybody's all in. But it is interesting that, as of this moment, Meta has gone sideways for the last 3 months. Amazon has gone sideways for the last 3 months. Microsoft has gone sideways until Nvidia just broke out. It was going sideways, and investors were finding other places.
That's right.
Okay. So let's just talk about the risk to that, because, I could sit here and talk about Palantir all day long. When ChatGPT came out, it had $2 billion in revenue. Now it's expected to have 4.2. It trades at 113 times sales. Okay. Not earnings, sales.
Yeah.
So
now that's expensive.
So in the last 4 years, they've doubled their revenue, only expected to grow, and half that revenue is probably assigned to AI sort of revenue, right? So there's some wacky stuff going on here, Mike. So let's talk about that, because I don't know how the market, to me, the bubble that is inflating right now is bigger than anything the asset world has ever seen. Yeah. Let's just be clear about that.
Yeah, but it is self-funded right now, meaning most of it's equity.
They're starting to tackle the debt and these SPVs.
They're just starting the debt part of that cycle, which, as you know, it took 2 years. And I'm not one of these guys that says, it's a bubble, but it's not going to blow up yet. That's kind of a cop-out. What I'm saying is I do see a spending cycle, but more importantly, let's get back to the economy. This is real. These are real dollars going into the economy. And the tax bill is written, it's not just a benefit for the hyperscalers, it's a benefit for the energy companies, for the power companies, for the manufacturing companies to retool their plants and equipment. And so to me, that's the interesting thing here, is that these asset-light businesses are no longer asset-light, as you rightly said, but that capital is now going to maybe spread the wealth into other parts of the economy that have been dormant. There are a lot of stocks that are cheap. They trade 10, 12 times earnings. They've been left for dead. And so that's the part of the story I think that looks interesting for next year.
All right, so the energy names that are on fire are all sort of AI adjacent names. What about energy names like your grandfather's energy names? Where do they fall into this?
Well, that's a story for 26. If the economy can really get going and they can truly run it hot and we get this wage thing going, then you're going to see consumption of energy pick up to the point where it's oversupplied right now. But I think that's a really interesting start for 26. I think it's a little early, okay? The whole natural gas complex, the whole, crude oil complex ultimately, but that's a 26 story, and I think it's quite interesting. The lower quality financials, right, whether it's the regionals or some of these areas that have not been seeing loan growth. We're just starting to see loan growth pick up perhaps as small businesses mid-cap, small-cap industrial companies that are going to see the fall down for all the stuff that we need to build, not just data centers, but all the hardware that's going into the broader economy.
So if your thesis is right, and you typically are, the KRE, for example, and again, we say it all the time, it's not the best constructed ETF, but small and mid-cap banks, which have been underperforming now for 4 years in a meaningful way, they should really start to excel, especially if you throw in the fact that there's going to be huge M&A, you would think, in 26.
And dereg, right?
And deregulation.
Right. So they're freeing up. And by the way, if you look at the reserves in the banking system, the regionals is the one where the reserves are actually way above their necessary. They don't have that stress. Now, there are certain instances where you have fraud or bad underwriting.
Yeah, but they didn't have that stress in 2023 because of the deregulation from 2018. And then in March of 23, we lost 5 or 6 regionals.
But you had a bank run, okay, because they did a really poor job of managing their balance sheet. They bought way too much duration at 1% rates. And then they got upside down because the Fed flipped.
So did our largest money center banks. If you look at Bank of America,
But I'm saying is that problem is now gone. Okay, yeah. And they haven't been making loans for quite a while. And it's clear the Treasury wants to kind of liberate the regional banking system, the regulated banking system, which is one of the reasons, by the way, I think some of the shadow banking stocks are trading so poorly. Is I think they're figuring out that the policy is going to favor the regulated banking system and maybe disfavor the unregulated banking system.
So what you're seeing actually is a bullish sign. I'm not trying to put words in your mouth, I'm not, but the weakness we're seeing on the shadow banking side actually could be portending strength in these
other areas. That's right.
Other areas.
That's right. It's a leading indicator potentially that the stocks are figuring out that it's not going to be as good at times as it has been, where they've been basically taking share relentlessly from the regulated banking system.
Yeah, that's not. That's not. I have not heard that, but it actually makes sense.
We try to be ahead of the curve.
Well, you typically are. So let's continue to talk about this. What about the large money center banks? Jamie Dimon just reported earnings. He came out and said, by the way, full disclosure, what he said at $305 about the bank being expensive, Said the same thing a year ago and was trading $205 in terms of valuation.
Sure.
Stock went up 50%. So you put any stock in just the valuations getting a bit ahead of themselves for the least names like that?
Well, sure. I mean, look. I mean, but the capital markets activity is legit. I mean, we saw it in the last earnings season, and that's also an area of pent up demand, right? I mean, if you're going to actually spend money, not like do financial transactions, but you're actually going to invest capital, then we need real capital raising, not just to refinance stuff. So it's not just M&A; it's capital market cycle. Doing the funding for these neoclouds. Okay, like there's a real cycle there. So
That's all debt.
what's that? It's all debt. I know, but they make money on that.
But let's go back to something because we kind of glossed over this, right? So when you think about these asset-light companies that are spending 30% of their revenue, now they're hitting the debt markets. Now these kind of data center build-outs are basically, they're putting up very little equity. They're getting a lot of debt. They're going to SPVs. Then all these shadow banking companies and, they're buying a bunch of the debt because it's actually, 1% over, so they're trading like junk, okay? Why would the debt trade like junk, okay? And they're going to find themselves into ETFs and all this stuff and mom and pops 401ks, right?
Yeah.
But let's take a step back. So you're building out all this stuff. You spent a ton of your cash flow, you know what I mean? A ton of as a percent of your revenue. And now you're putting money into things that are going to depreciate much faster than I think are on the books or the way that these things are projected to depreciate. And if you think back, and there was an article, I think Spencer Jacob in the Wall Street Journal this morning is talking about, listen, in past cycles, when you invested in railroads or fiber optics, you got the benefit of that for decades, right? Now, these things, you got to go from Hopper to Blackwell to Rubin, and there's going to be all these different cooling systems. I mean, it's going to go on and on and on, right? So I think you're going to say, well, that's great investment in this. But sooner or later, there's going to be a digestion period. And that digestion period, because if the demand doesn't materialize, could be devastating for risk
it's
assets.
going to be uneconomic. Okay, so let's just peel the onion all the way back, which is I have no doubt that what's going on now is going to end up in malinvestment, mainly because the biggest beneficiary is a monopoly extracting monopoly rents. Right? So technology never works until the actual price per unit of compute comes down to a level that three of us can afford and everybody else. We're a year away from that. But when that happens, there's going to be destruction of investments on the back of that. But to your point, maybe it has to be upgraded at some point, and it has to be keeping upgraded. They're going to find cheaper ways to do that. In other words, the next round in 2, 3, 4 years is not going to cost the same. Okay, it's going to be more of a maintenance item.
Well, what do you make of the fact that all of these major hyperscalers, they're like literally going after the same exact thing? Whether it's AGI or superintelligence, and then it's become a pricing thing.
Yeah.
Who can underprice the next for that compute, right? And so that's where I feel like if you're a neocloud, you're going to be left holding the bag with all that debt. If you're Oracle with 500% debt to equity, you're going to be left holding the bag, right? And so that's what. And then let's talk about China and talk about the competition there. If we ever have another DeepSeek moment, right? If we ever have them innovating because of these export bans, and who knows if that gets sorted out, right, in the next year or so with this whatever trade deal that we have. I just think there's a lot of risks that are being totally underpriced right now.
Well, I mean, look, we're in a bit of a euphoria at the moment. There's a lot of excitement. I think the investment part of this, the picks and shovels, is probably fully priced, if not overpriced. But that doesn't mean that the AI cycle, the benefit of the AI cycle is years in the future. That's the application layer. That's the new businesses that are going to be created using this cheap compute that somebody else paid for. We've done, you know this as well as anybody. I mean, the big winners of the internet were the platform companies, not the guys who built it. They're in the graveyard. Okay, so now the difference this time is that the platform companies are doing the spending. They have great core businesses, so they're not going to zero. Okay, like they're not going to go out of business. But I mean, are there future returns? Could their future returns be anything like their past returns? There's zero chance of that, mainly because of their size, okay, but also because they're now investing.
Well, why couldn't you, Mike, in 2022, we saw Nvidia, Meta, Netflix, and Tesla go down 65, 70%. And they, all these companies went down 35% of their stocks did. And so the likelihood, if we talk about like some sort of malinvestment and misallocation of resource, we haven't really even talked about competition and pricing and all that sort of stuff. Why couldn't these stocks, why couldn't a $5 trillion market cap company go back to be a $2.5 trillion market cap?
Well, we saw that happen from July of 24 to April of 25. People seem to forget that. That was last year. I mean,
yeah, but there was still the enthusiasm.
There was not.
No, there was enthusiasm about what might come.
Sure, but I mean, that could happen again. I mean, who's to say that we don't have another serious correction in this whole space? but the dream is far from over. In other words, the dream
Well,
wasn't.
it will be far from. We get that. Like, I get it.
Well,
I use
I don't know.
ChatGPT like 100 times a day. I
Sure.
think it's amazing. But
That's
like
right.
enterprises aren't using it yet.
But I'm not. What I'm saying is that remember in 2001 and 2002. I mean, it was 24 months of coming in every day, and you were down another 4, down another 5, and then they didn't really get off the mat. Okay, like I don't anticipate that right now because I still think there's enough spending. There's still enough on the come, and there's not enough debt yet to force the hand of the forced deleveraging. Right? I guess so. I just think I don't know what inning it is, but I don't think it's the 9th inning yet. I don't think this is a time when you should be running to the sandbox and saying, "Oh my God, the whole thing's going to crash tomorrow." You know,
Global bond market has cooled down. There was a period of time, late summer into the fall, where global rates were moving higher. U.S. rates were not, but it felt like something was going to happen. Things have cooled off considerably. Is there anything in the bond market out there?
There was, and then it calmed down. So, like technically, I would say the back end of the bond market looked like it was going to make another move to the 4.5, 4.75 range, and that just completely calmed down in the last month. So, it looks to me like the long end bond volatility is okay for now. What I'm more focused on now is the front end funding markets. That's where the stress seems to be.
Well, you're talking about the repo markets.
Correct.
And I mean, yeah, a lot of people are writing about it. Nobody wants to sort of get in the weeds with this stuff, but yeah, it's concerning.
Yeah, well, I think. Well, by the way, this is why the Fed is ending QT. They're paying attention.
They have to be paying
They
attention.
know. And by the way, they remember 2019 where it really got away from them, and then they had to come in and do QE. I don't think they want to do QE again, so they're trying to prevent that by at least ending QT. And my guess is, as we go into year end, there's going to be more of this. And like that's my number one. Like if I had to say what's the biggest risk for a correction between now and year end, okay, it's probably that because it's so hard to predict when that becomes an issue. Now, if it were to happen, I know what they're going to do.
Yeah.
So like,
it'll clean it up very quickly.
It'll mop
But
it up.
it'll be however many day period of time where it scares people are scared shitless. I mean,
Right.
we've seen the overnight rates. We've seen weird things happen over the last 5 or 6 years.
Right. And but I would say, like that, there was risk of that in the last 2 or 3 weeks and it calmed down. So and now they're on top of it. So maybe this isn't an issue anymore, but it's going to be like something like that worries me more than trade. Like say 2 weeks ago, trade was my number one concern. I thought that could go a little bit sideways. Seems like that's under control now. The second one, which is to be determined, we may know a little bit here in an hour or two in terms of how these stocks react. And but these are correct. Those are pullbacks and corrections. That's not the beginning of something I think more serious like July of 24, where that was the beginning of an AI CapEx deceleration cycle, that bled into January, February, March, and of course, was punctuated with Liberation Day.
We're at the end of 25, effectively. You mentioned energy is a 26 story. Does healthcare fall in? Utilities are a completely different animal. So I'm not even going to talk. But healthcare has been sort of loved, underloved, under sort of the crosshairs of the administration, taken out of that crosshairs.
Yep.
Thoughts on healthcare in 26?
So we upgraded healthcare in early September, on the back of what was RFK Jr.'s announcements that didn't seem to be as onerous as people were fearing. The most favored nation pricing, and that actually could end up being accretive for some pharma companies. And then, of course, interest rates coming down is usually good for biotech. And so we've now seen some transactions there. So, I mean, healthcare a month and a half ago was the cheapest it's ever been on a relative basis, worse than like post-Hillary care. Worse than in the mid 2000s. There was a really dire period for healthcare stocks. It's been thrown in the garbage dump. So yeah, healthcare to us looks pretty interesting. If you want to have a defensive hedge against some of your more pro-cyclical areas, that's the one. No, not utilities.
Industrials, obviously, they've had this stealth rally that nobody's talking about. We talk about names like Caterpillar. A lot of this is on AI, though, if
That's
you
right.
think about it.
100%.
26, a continuation of that theme.
Well, it'll be different, right? So the AI thing, I think, is priced. What's not priced is this more broader capital spending cycle for other things. Let's say transportation is another area of the market that has literally been dead
Awful.
for 4 years.
Yeah.
Okay, the transportation index is below its 2021 highs. So it tells you that there's if you get activity picking up in just transporting goods around the country again, well, that's Class 8 trucks. That's you get a maintenance on this equipment. So I do think that industrial spending is going to be very robust next year, but it may be in areas that we haven't seen robust spending for the last 2 or 3 years.
All right, Mike, let's end here for a sec because, again, you just talked about the potential for a 10, 15% correction. I think that always lurks out there, right? We see one almost every year.
That's
We
right.
already had the big one, and I think we can all agree that was a bit self-induced. I'm looking at this market right here, and I see a lot of weakness. I see breadth that's been really poor this whole week into these events that we've talked about, whether it was trade, whether there's a Fed, and now all these, big earnings that we see. And so I'm just curious, like, how do you think, if we do get that 10% correction, the S&P was 6,200-ish before Liberation Day. I just said it. I haven't said that in a long time, right? And then we had that downdraft. And then once we kind of broke out above those levels, it's been really off to the races, right? It's just been this like 45-degree thing. And I don't think anyone thinks it can really come in. So if we've gotten by, let's say after earnings this week and everything looks good, and you think that maybe the labor market firms a little bit, you think inflation, is fine if it goes up a little bit from these levels, what becomes the big risk, right? If you think about it, like, how does the market decide to go down 10, 15%?
It's price. I mean, basically price forces people's hands. We saw this big momentum unwind in the last month. I mean, it was a pretty significant unwind, and some of the, shops that are levered to that were down quite a bit. So you could say the market is correcting internally. Part of your story about negative breath, the market is correcting, right? Some of the froth is coming out of, there are parts of the market, I won't mention specific names, but they're ridiculous in terms of their valuation. There is no revenue. There's nothing. And
you're talking about a lot of quantum names, but yes, 100%.
Just a bunch of names.
Yeah.
It's not. It's a whole pocket of this area. That stuff, I would love to see that stuff come in. Does that mean the S&P has to go down 10, 15? Maybe, but if that other stuff corrects a lot and the S&P chops around and goes sideways, that's a win. Okay,
huge win.
You want to take that. That's the stuff that needs to get corrected to me. I don't think the S&P is wildly overvalued. We just went through that. Okay, so I don't think we need to have.
Well, the S&P's not. And remember, in 2022, in October, we still had, the rest of the S&P was trading at like 12, 13 times at a trough multiple, right? And so, but what took us out of that? We know what took us out. It was the mega caps, and that's when the Mag 7 became a thing and everything like that. So isn't the opposite of that potentially true, that you've had this rolling sort, and you've been talking about this for 2 years, this rolling recession or this correction in different sectors. The risk is obviously that you have the hyperscalers, Nvidia, and all these Johnny-come-latelys of some of this stuff that we just started the conversation with in tech, that they have a material correction. SanDisk was $50, 2 months ago, and now it's $200 and at an all-time high. So there's a lot of risk, I think, to those names that you could say, well, that's a $50 billion market cap company. It doesn't matter. But that thing starts going lower when you have the multi-trillion-dollar ones kind of losing some ground.
Yeah, no, that's what should happen, okay? And I think it began 6 weeks ago. That's what I'm trying to say.
Yeah.
I think it already has started under the surface, and how it completes that correction is TBD. But either way, I want to end with this, which is I think a new bull market started in April. It came on the back of a significant bear market and a recession, which means the bull market has got at least a year to go, in my view.
Mike Wilson from Morgan Stanley, at least the 9th time he's been with us, maybe the 10th, but he will be back again. Maybe not before the end of the year, because we're almost in November.
Sure.
But he'll be back in early 26. Thank you,
Thanks, Mike.
All right, guys. Thanks.